morning, and how do you do, ladies and gentlemen? Welcome to this morning's brief. Today, of course, is March 7th, 2023, 9:23 Greenwich Mean Time. We are looking at the net two contracts. The candlesticks here are the United States natural gas contract deliverable at the Hudson Hub, and the top one is the TTF Euroland natural gas contract that delivers in Rotterdam. Now, hard to, from last August, takes this precipitous fall, both in Europe and the United States. Before I proceed, let me make clear that I've converted the Euroland contract to a U.S. contract. The U.S. contract is priced in dollars per use, and the Euro contract is priced in euros per megawatt hour. So I've converted it to dollars to an equal unit, millions of BTUs. And here's the price differential. It's 3 times, in the US it's say 260 handle, and the Europe, and it's 1314. That's 300% more. It's a 300% price differential. Now, what we need to understand, and before I go any further, let me explain that this is speculative insight, and therefore has a potential of being wrong. So you should only be trading with capital in these markets that you can afford to lose. There's risk. Well, risk being defined as the probability of the unexpected occurring, and occur it does. Unexpected things occur all the time in these markets and can severely damage your position and therefore your account. So you have to trade accordingly to the volatility and your ability to absorb losses. Well, losses there often and almost always are. Now then, this chart shows you when the invasion prices pop, and then after August they decline. Similarly in Europe. Now this is the thing. The gas valves were shut down completely from east to west in October. So even now, 61% of storage is full in Europe because the winter has been mild. They burned a lot less of the stuff than they thought, which has led to this price drop and a general sense of euphoria. If you look at the stock market indices in Europe, the Madrid, the Milan, the Frankfurt, the Kakaron, the FTSE too even, they're all up significantly this year because of this general sense of mistaken sense, in our opinion. Again, this is our opinion. We could be wrong. That this is the war will wind down soon. It'll come to an end. They're going to have to start replacing the gas that they did burn. Remember, those tanks were about 91% full at the beginning of the winter. So now they have to replace that 30% with other gas. Now, there's no other Russian gas coming in. So we assume that the price of U.S. gas that's going to be increasingly in demand there will sell at a higher price than it's currently selling now in the U.S. contract, which is exactly $2.67. Certainly not likely to reach the European price because that's completely, I wouldn't say gone or irrelevant, but the markets have been so rigged and jigged. As a matter of fact, just today, the European Union is going to start purchasing oil in a more unified, or at least the attempt is to unify the purchasing structure so that there's a small percentage of it will be cooperatively shared, the rest not. And keep in mind, the reason, in our opinion, the price is low in Europe is because there's not really that much demand. They can't take in that much gas. Their whole system of supply has been based on the flow from west to east, from Russia into the European market. Those valves are all shut. Those pipelines are all closed. And so the only other alternative short of building pipelines, which takes a bit of time, is to offload liquid natural gas, which is remarkably difficult because the major ports, one in Portugal and one in Spain, are, believe it or not connected to the European gas network. Now, well, we won't get in. We've had sessions, and you're welcome to tune into sessions we do on the weaponization of natural gas. We'll repeat that probably in the very near future. Nonetheless, it seems to us that this price rise here that's taken place from let's get rid of this for a moment. So it's 300%. I don't know, just enough to see. The price rise that's taken place from February 21st to today, March 7th, is driven by tremendous volume. And that volume indicates a significantly powerful sentiment behind that rise, meaning that there are a lot of people bought in. Even though the price didn't move that radically, it's moving. And so, let me just take it back a tad. Yes, you can see extreme volume. The Elder Force Index is way over the moving average. Nonetheless, regardless of the indicator itself, you can see that there's something going on here, and we think it's the beginning of the resupply season, so that they'll be ready for next winter, and that's going to cost them a lot more than it had been to fill those tanks. So we expect to see price rising. It's just crossed over the 20-day moving average. This is the U.S. contract. It's headed up to the 50-day moving average, which is 350. And, of course, the 200-day, which is, still pretty close to August, which is, 520. But I just want you to see what the equilibration or the conversion of the contracts means. These are both priced in dollars and millions of BTU. The U.S. price is here at 260. The price here is 1314. An enormous difference. So we think that gap is going to be filled largely through the rise in price of gas supplies. That's going to do it for now, ladies and gentlemen. I'm your host, Seth Julian, wishing you all the ability to trade with confidence. Bye-bye for now.